Hey everyone! So you're probably feeling it, right? The economy's sending some seriously mixed signals. I mean, on one hand, things are slowing down globally, but here in the US, the job market is still hanging on. And inflation, well, it just won't quit. It's this weird, confusing situation that has everybody asking one massive question. Is that big recession everyone's been talking about for 2026 still coming, or did we somehow manage to sidestep it?
Okay, to figure this out, we've got to look at the one indicator that for decades has been the most reliable predictor we have. It's called the inverted yield curve. Now, that sounds complicated, but the idea is actually pretty simple. It's when the market is so worried about the near future that it demands to be paid more for a short-term loan than a long-term one. That's completely backward. It's a huge red flag, and for the last 50 years, it's been an incredibly accurate warning shot. And when I say accurate, I mean, just look at this record. It's perfect. 1980, 2000, 2008. Every single time this thing has inverted over the past half century, a recession has followed, usually about 18 to 24 months later. There have been literally zero false alarms. So you can imagine when it inverted back in 2022, everyone buckled up, waiting for history to repeat itself. But then, something weird happened. That famous inversion that kicked off in 2022, it's over. The curve uninverted, and yet the economy is still chugging along. So this brings up a massive $20 trillion question for all of us. Did the world's most reliable predictor just break for the first time ever? Or is the time bomb just on a slightly longer fuse set to go off in 2026? And that question right there is at the very heart of the great debate that's splitting economists and Wall Street right down the middle. Is the danger over, or is the time bomb still ticking? So on one side of the argument, you've got the big banks, like JP Morgan here. Just last year, they were saying there was a 60% chance of a recession. But as you can see, they've actually walked that back, lowering the odds to just 40%. They believe the economy is just more resilient than anyone gave it credit for. So really, it boils down to two main camps. First, you've got Team Soft Landing. They're the optimists. They say, look, the Fed's high interest rates are working, inflation is cooling, and rate cuts are probably coming in 2026. The strong job market will soften any blow. They're not predicting a crash, just a slowdown. But then you have Team Hard Landing. They're saying, not so fast. They argue that the full pain from all those rate hikes, what they call the lag effect, hasn't even really hit us yet. They point to the housing market being in a deep freeze and say that the yield curve's perfect record is still in play, with that 18 to 24-month delay pointing right at early 2026. Okay, so the experts are completely divided. What is the smart money doing right now? Well, instead of betting on who's right, they follow a time-tested playbook to protect their money and get ready no matter what happens. Let's walk through that playbook. The very first move is a classic one. It's a shift into what are called defensive sectors of the stock market. You might call this the boring is beautiful strategy. It's all about focusing on industries that people absolutely rely on, whether the economy is booming or busting. And the logic here is just rock solid. Let's take consumer staples. Think about it. When times get tough, you might put off buying a new car, but you were definitely still buying toothpaste and toilet paper. Same with healthcare. People don't just decide to skip essential medicine. And utilities, well, unless you enjoy living in the dark, you're going to pay that electricity bill. These are non-negotiable parts of life, and that's what makes these companies so stable. Now, the flip side of this is just as important. It's about avoiding the sectors that get hit first when people start watching their wallets. And that's consumer discretionary. We're talking about the companies that sell things like luxury handbags, brand new cars, expensive vacations. All the nice-to-haves that are the first things to get cut from the budget when things get tight. All right, but a truly recession-proof strategy isn't just about stocks. Savvy investors don't just play defense. They're also on the lookout for stability and opportunity in totally different kinds of assets. And this is where we see a big shift toward real assets. Gold is the classic go-to when people are scared. High-quality bonds actually become more valuable when interest rates are expected to fall, which is exactly the forecast for 2026. And then there are things you can actually see and touch, like real estate, but bought through things called REITs, which are basically funds that own big properties like apartment complexes or warehouses. And for the super wealthy, this means private companies and infrastructure, things not tied to the stock market's daily drama. And here's a really interesting example of where they see that opportunity. We're talking about specific types of real estate investment trusts, or REITs.
See, while the market for buying a house is basically frozen, the demand for things like apartment rentals and data centers is still through the roof. And that's why these kinds of core real estate assets are projected to deliver stable returns of over 8% for 2026. They offer both income and stability. So, this all leads us to the final and I think most important piece of the puzzle, a simple three-step strategy that pretty much anyone can use to get some peace of mind in this crazy environment. This is the sleep at night plan. So, look, the goal here isn't to time the market perfectly. Nobody can do that. It's just about being ready for whatever comes next. It's three simple steps. First, build up your dry powder. That's just a fancy way of saying have cash ready, maybe from taking some profits after the 2025 rally. Second, shift your mindset. Right now, the goal is survival, not trying to get rich overnight. It's about protecting what you've built. And third, prepare for the opportunity. Because if a downturn does come, it will be the single greatest buying opportunity of this decade for people who have cash ready to go. And this quote right here just nails the entire philosophy. Your number one goal when things are uncertain is to protect what you have, to not get poor. If you can do that, you'll be one of the very few who has the cash and the courage to build some serious wealth when everyone else is panicking. So maybe the final question isn't whether the 2026 recession is coming. Maybe the real question is, will you see it as a crisis or as the opportunity of a lifetime?